Did you check the balance and quietly think, this is pointless? That reaction isn't impatience, it's arithmetic you can't see yet. The first decade of compounding genuinely looks like nothing is happening. So tonight we'll walk through 5 chapters: the arithmetic decade by decade, the 2 specific years when the curve stops being flat, the decades in the countries where this did not work at all, and the short list of things that are actually in your hands. The 4th chapter is the one most versions of this story leave out: 34 years in which patience paid nothing, and what protects a patient investor from that. No predictions here, no tips, just the shape of the math and the temperament it asks for. Picture the moment this usually begins. It's late on a Tuesday. A laptop is open on a kitchen table, and someone is setting up a recurring transfer. $200, the first of every month, automatic. Their finger hovers before they confirm it, because $200 feels like almost nothing. It's a phone bill, a week of groceries, a tank and a half of fuel, and the number they keep reading about, the one attached to other people's retirements, is $500,000. The distance between those 2 figures doesn't feel like a plan, it feels like a joke someone else is in on.
So let's take the joke seriously and do the arithmetic properly, including the parts that don't flatter anybody. Chapter 1. The Quiet Arithmetic. $200 invested at the start of each month, an assumed growth rate of 7% a year, compounded monthly. 40 years. Treat every figure that follows as illustration, never as a promise. The assumption is doing a great deal of work, and I'll pull it apart in a moment. Under those assumptions, the ending balance is about $525,000. Now, where does that money come from? 480 transfers of $200 each. That's $96,000 that actually left your bank account over 4 decades, which leaves roughly $429,000 that you did not deposit. 4/5 of the final balance is growth. The money you contribute is the smaller half of the story, and it isn't close. But the total hides the lesson. The decade-by-decade view is where it lives. After 10 years, the balance is about $34,600. After 20 years, about $104,000. After 30 years, about $244,000. After 40 years, about $525,000. Read those 4 numbers again slowly, because their spacing is the entire point.
The final 10 years added roughly $281,000, more than the first 30 years produced in total, and of that $281,000, only about $24,000 was new money from you. Roughly half of the entire final balance arrives in the last 9 years of the plan. 3 caveats, and I'd rather carry them out in the open than bury them. First, 7% is an assumption, not a schedule. The same $200 over the same 40 years lands somewhere near $400,000 at 6% and somewhere near $700,000 at 8%. That spread, roughly $300,000 wide, is the truthful picture. Anyone who gives you a single number without that spread is selling something. Second, on where 7% comes from. U.S. stocks have historically returned roughly 10% a year in nominal terms since 1926, and roughly 6.5% to 7% after inflation. So 7% is a defensible planning figure. It is a long-run average drawn from a century that has already happened, and averages of that kind arrive unevenly, if they arrive at all. Third, and this is the one that costs the most to say, $525,000 in 40 years is a nominal number. At 3% inflation, it would buy roughly what $161,000 buys today. If what you want is $500,000 in today's purchasing power, your contribution has to rise with prices, somewhere around $650 a month by year 40. That's a real requirement, and I'd rather you hear it now than discover it at 60. The arithmetic does scale cleanly in both directions, which is quietly encouraging. $50 a month produces about a quarter of the result. $500 a month, about 2.5 times it. So the number in the title is real. It simply belongs to the 40th year, not the 4th. Which raises the question this whole plan lives or dies on. What does year 4 actually feel like, and why does it feel so much like failure? Chapter 2. The picture in the developer tray. Anyone who has developed a photograph remembers the waiting. The exposed paper slides into the tray, and for a long stretch it is simply blank, white, featureless. You start to wonder whether you got the exposure wrong. Then, in the last few seconds, the image arrives all at once. The shape, the shadows, the face. Nothing changed about the chemistry at the end. It had been working from the moment the paper went in. Only the visible part came late. That is the shape of a compounding account, and it explains why the first decade feels the way it feels. This isn't a personal weakness, and it isn't a lack of discipline. It's been measured. Stango and Zinman, writing in the Journal of Finance in 2009, gave it a name, exponential growth bias, and found that people systematically underestimate how compound growth accumulates. We extrapolate in straight lines, because straight lines are what our intuition is built for. And the finding that matters most for you is this: the individuals most prone to the error saved less over their lifetimes. The misperception doesn't stay in the head. It reaches into the bank account and turns off the transfer, which is why it helps to know, in advance, the 2 years when the image begins to appear in the tray. Using the same illustrative 7%, the first crossover lands somewhere around year 10 or 11. That's when the account first earns more in a year than you put into it. You contribute $2,400 over those 12 months. The balance, sitting around $34,000, generates a little more than that on its own. Nothing announces it. No notification arrives. But from that point onward, you are no longer the largest contributor to your own account. The second crossover lands around year 18.
That's the month when total growth first exceeds total deposits, when more of the balance came from the market than from your bank. Both of those moments arrive years after the point at which you'd most want to see them. That lag is the whole difficulty of the strategy. It asks you to keep faith through the blank stretch, using nothing but arithmetic you can't yet observe. There's a second problem hiding underneath, though, and it's the one that makes people quit even after they've accepted the timeline. The chart in your head is a smooth curve, rising politely. The actual path is nothing of the kind. Chapter 3. The Snow Falls Unevenly. The image behind this recording's title is a snowball on a long hill, a small thing gathering what it rolls over. It's a fair picture of the mechanism, and I'll nod to it once here before admitting exactly where it lies to you. It lies about smoothness. Real markets don't roll. They lurch, stall, and lurch again. J.P. Morgan Asset Management's Guide to the Markets has tracked this in a single chart for decades. Across calendar years since 1980, the S&P 500 has fallen roughly 14% from peak to trough at some point inside the average year, and still finished those years positive about 3 times in 4. The frightening year and the profitable year are usually the same year.
Most of the time, the drop you remember and the gain you eventually collect share calendar. The unevenness runs deeper than that, though, and this is where it becomes expensive. Returns aren't spread across trading days like butter. They arrive in clusters. J.P. Morgan's Guide to Retirement, drawing on Bloomberg data for the 20 years from 2003 through 2022, put it in numbers you can hold. An investor who simply stayed put earned roughly 9.8% a year. An investor who missed only 10 vest days across those 2 decades earned roughly 5.6%. 10 days out of about 5,000, and nearly half the return is gone. I'd note that these publications are updated annually, so the exact decimals shift by addition. The finding is what matters, not the last digit. And here's the detail that turns this from trivia into something about human behavior. In that study, 7 of the 10 best days fell within 2 weeks of the 10 worst days. The best days are not scattered across the sunny stretches, waiting for confident people to show up. They are embedded inside the panics. They sit right next to the days that make you want to leave, which means there's no version of the exit that keeps them. Whatever you tell yourself about stepping aside until things calm down, the calm arrives after the cluster, not before it.
The money compounds, the path is jagged, and leaving is costly. That's the standard case, and most finance content stops there, having quietly assumed the one thing it never proves, that the hill goes on forever. It doesn't always. Let's go and look at where it stopped. Chapter 4. The hill that ran out. The Nikkei 225 closed at 38,915 on the 29th of December 1989. It fell as low as 7,055 in March 2009, down about 82%. It did not close above that 1989 level again until the 22nd of February 2024. 34 years. An entire working career of patience, and the index gave nothing back for it. Sit with that before I offer you anything. Someone in Tokyo in 1989 did everything this recording recommends, bought broadly, held on, kept transferring, and reached retirement age with the index exactly where they'd found it. That happened. It is not a hypothetical. The United States has its own smaller version. From 2000 through 2009, the S&P 500's total return was roughly -1% a year, about -9% for the whole decade, dividends included, the only negative decade since the 1930s. At the level of individual companies, the wreckage is worse.
General Electric was removed from the Dow Jones Industrial Average in June 2018 after 111 years, the last of the original members to go, with its shares a small fraction of their 2000 peak. Citigroup executed a 1-for-10 reverse split in 2011 and, adjusted for that split, has never come close to its 2006 high. I mention both strictly as history, not as any comment on those companies today. Just be patient would have been useless advice to anyone who had concentrated their savings in either, so the objection stands at full strength. Compounding is not a law of nature, it's a historical pattern, and patterns have exceptions with real people inside them. Now, 3 answers. One of them concedes ground. The first is to own everything rather than something. Hendrik Besembinder's 2018 study in the Journal of Financial Economics looked at U.S. stocks from 1926 to 2016 and found that just 4% of listed companies accounted for the entire net wealth creation of the market above Treasury bills. About 58% of stocks underperformed one-month Treasury bills over their lifetimes, and the single most common lifetime outcome for an individual stock was a total loss, which reframes what happened to GE and Citigroup. They aren't anomalies, they're the base rate. Broad ownership isn't a clever way to earn more.
It's the mechanism that guarantees you're holding the 4% without having to identify them in advance. The second answer is the concession. Global diversification helps less than it's usually sold. At the 1989 peak, Japan was roughly 40% of world equity market value, so a genuinely global investor still carried a heavy load of it into the fall. What actually rescued that period was owning things that were neither Japan nor U.S. large caps. During the American lost decade, for example, emerging markets and U.S. investment-grade bonds both delivered solidly positive annual returns, while the S&P 500 went nowhere. Spreading across asset types did more work than spreading across countries alone. The third answer is the one that belongs to the person at that kitchen table, and it's the turn this whole recording rests on. A monthly buyer's arithmetic is not the index's arithmetic. The Nikkei needed 34 years to return to one particular date's price, but that's a statement about a single starting point. Someone still transferring money every month through those decades was buying continuously, most of it at prices far below that 1989 peak, and their own break-even arrived a great deal earlier than the indexes did. How much earlier depends entirely on the schedule, so I won't attach a number to it.
But the logic holds. The flat line on the chart and the experience of the steady buyer are two different things, which points at where the real danger actually sits. It isn't a flat decade in the middle. A monthly buyer survives that, and in some ways is fed by it. It's a flat decade at the end, when you've stopped adding and started withdrawing, selling units into a trough to pay for groceries. That sequence of returns risk and willpower does nothing about it. It's handled structurally, shifting toward bonds and cash as the withdrawal date approaches, holding a spending buffer so you're never forced to sell at the bottom, and keeping withdrawals flexible in bad years. So the question to carry isn't whether the market will cooperate, it's whether your plan survives the decade where it doesn't. And that question leads somewhere unexpectedly practical, because almost nothing in this arithmetic is within your control, but the parts that are turn out to be worth more than the parts that aren't. Chapter 5. What stays in your hands? A ferry leaving harbor 1 degree off its heading is still within sight of the correct course an hour later. Nobody on board notices. Over an ocean crossing, that same 1 degree lands the boat in a different country. Costs work like the heading, run the same illustrative numbers.
$200 a month for 40 years at 7% ends near $525,000. At 6%, it ends near $398,000. 1 percentage point, roughly the difference between a low-cost fund and a merely ordinary one, is about $127,000. Hold that against your total contributions of $96,000. Over that span, the fee costs more than everything you deposited. That's the whole of John Bogle's argument, and it needs no decoration. Costs are subtraction, and subtraction is the one component of your return that's knowable in advance. The second leak is behavioral, and it's been measured too. Morningstar's annual Mind the Gap study compares what funds returned with what investors in those funds actually earned, and consistently finds a shortfall of roughly 1 percentage point a year over the decade studied.
not caused by bad funds, caused by money arriving after the good stretches and leaving after the bad ones, which puts the cost of flinching in the same range as the cost of an expensive fund. The third lever is duration, and it's the least forgiving of the three. The same $200 over 30 years instead of 40 produces about $244,000 rather than $525,000.
Less than half the result for 75% of the effort. 10 years at the end are worth more than the 20 at the beginning, which is an uncomfortable thing to learn at 45 and a useful one to know at 28. And then the cheerful part. Because the calculation scales linearly, raising the transfer from $200 to $300 raises every figure in this recording by 50%, permanently, without requiring a single opinion about markets, interest rates, or what happens next year. There's no cleverness available in any of this, which is exactly the point. The amount, the years, what you pay, whether you interfere. Everything else is weather. So let's go back to that balance you checked, and the quiet verdict you passed on it. It wasn't wrong exactly. At year 2, $4,000 against a headline of $500,000 really is absurd, as a ratio. What you were missing wasn't optimism, it was the spacing of the numbers. 34,000 at 10 years, 104 at 20, 244 at 30, 525 at 40. You are standing at the flattest part of a curve and reading it as a straight line, which is what human beings reliably do. You know the sequence now. Around year 4, that old suspicion will return, that the math belongs to other people.
Around year 10 or 11, without any announcement, the account will start earning more in a year than you put in. Around year 18, growth will pass everything you've ever deposited. And in the final stretch, the part that feels furthest away tonight, more will arrive than in the first 3 decades combined. None of that is promised and none of it is a forecast. It's the shape the arithmetic takes when it's left alone, in a market that behaves roughly as markets have behaved. Compounding doesn't reward intelligence or nerve or good timing. It rewards duration. And duration, mostly, is a matter of not interrupting yourself. The snowball doesn't need you to push it. It needs the hill to stay long, which means it needs you to stay put. If something here was useful, consider subscribing. There will be more of these, and they're meant to be listened to slowly. And if one idea stayed with you, the crossover year, the blank paper in the tray, the 34 years in Japan, the fairy 1 degree off, leave a comment and tell me which one. I read them, and they shape what gets recorded next. Thank you for spending this time here. Go gently.